Before we begin, a quick disclaimer. This podcast is for entertainment and information purposes only. It should not be relied upon as a base for any investment decision. For solicitation or to buy or sell any security, either the host, guests, or clients of either may own securities discussed on this podcast. Okay, cool. And then on to sum it up, it's team, its size, and the last thing was, I'm sorry, I'm blanking on it. Team size and the warrant structure. So yes. That's what your main points, great points. Then on team, I'm always a little bit confused by that, because what people call a great team, it varies enormously by who you're talking to. Well, it varies. And so what do you think about like a Sam Zell SPAC? Is that
Well, there's a bit of a tension in my mind between an investment where I am the marginal investor when all is said and done, and an investment that works very well in this particular environment. Those are closer to antithetical attributes than aligned attributes right now. So, I mean, clearly there's bad SPACs and bad investments and good SPACs and good investments. But in terms of sector and focus, a lot of the things that I find the most analyzable are less in fashion right now, that are real value investments that have actual metrics that you can scrutinize and you can pick a level that you would want to invest in versus a pre-revenue aspirational thematic target, and those are doing really well right now. So you kind of have, and I don't mind. I'm not a martyr. I'm not kind of waiting for the world to turn to value investing. I'm happy to kind of pick at some that are both. I mean, from a portfolio management perspective, you kind of want a little bit of diversification between the two and a little bit of awareness of which one you're going for. The ones farther afield from tech and specifically ESG are where I'm a little bit more relevant, as I might want to stay in this long term. But boy, there's $40 trillion chasing ESG as part or whole of their mandate. And there's not that many companies. I mean, just kind of from a supply and demand perspective, even if I'm not the marginal demander of this kind of investment, there's just a ton of demand. And you see in SPACs, sponsors reacting, sponsors that were in it for doing oil and gas, kind of Texas oil men with big hats that were looking to drill in 2019 saw energy implode, and they're doing kind of clean battery deals, and they're flipping. They're giving the people what they want, and people want batteries and electric vehicles. So there's kind of one or the other, and I'm flexible, but clearly, once the process is done, I'm sticking more with the things that I would actually want to be invested in. Okay.
So yeah, I was trying to give you like a little bit of a difficult one where it's not a no-brainer of saying like.
No, it's not a no-brainer. And if I was, let me say this, of all of my sins of omission and commission, the biggest opportunity cost for us has been me being too principled, sticking too close, where I buy something at a price that I think is great and then jump out once it goes from a price I think is low to about right, which might be 3 or 4% of the way through something kind of launching, and being a little bit less pedantic and a little bit less principled, or diversifying philosophically away from a value investing ghetto and saying there are different investors, there are different tastes, there are different things. I'm 100% responsible for prices that I pay, 100% responsible for prices that I get, but it's not my job to avoid anything other than a very narrow value investment throughout the process. Being a little flexible, a little diversified on that has been helpful, and I've kind of been too picky historically and avoided a lot of the kind of spectacular outcomes. It was very funny with Jeremy Grantham, who's somebody I've long liked and admired and been kind of like-minded about. He's a cranky old man about SPACs, and he's made hundreds of millions of dollars in SPACs, kind of by accident, kind of just backed into things in one example. But he's
he was like an early investor in QuantumScape, and he's like a legend in the value investing community. And I think this is his best investment he's ever made in his life.
It must kill him. It must kill him. Yeah. No, he'll have hundreds of millions of dollars to compensate for that. But I mean, there just couldn't have been.
I think he made it because he's quite passionate about energy transition. Yeah. And that's really important to him. So I'm not even sure if he, if it's the one time he doesn't like do super valuation work or something. And
well, I think it was almost philanthropic. So Gates Gates is a funny example as an investor, because I think he's been very good in a lot of ways. But of course, his whole investment life would have been better had he just kept Microsoft and never done anything else. It's all had a cost. It's all been worse than just hanging on to his Microsoft. So he's certainly kind of diversified beyond that. But he's had a very, very good career as an investor. I think he's had maybe best of anybody in the history of the world as a philanthropist. And he's had a very interesting career in the middle, a category that I'm generally skeptical on. I generally do better monotasking for profit or for utility, but for philanthropic utility is a separate topic from investing. I'm not an ESG investor. I'm a skeptic of ESG investing. But he's had a very interesting career in this middle category that's not exactly ESG. It's kind of say, hey, there are things that I want to do. It's best structured as a for-profit vehicle, but our mission is one for humanity, for the future. We have these things we want to accomplish. We're going to do it for profit. But if I lose all your money, you can't come back to me and complain about how much I make or lose. He's actually done really well in some of those things. So I don't.
It's like the nuclear fission kind of investments.
Yeah. But so I don't know the specifics. So I will preemptively surrender if somebody who knows all of the facts takes issue with this. But I rather suspect that Grantham was caught up in something that was in that category of a mission-focused, nominally for-profit, and then it got de-SPACed and ended up worth hundreds of millions of dollars.
Yeah, that's great. I think you've been involved with that one, maybe with the warrant arbitrage or invested from the get-go, or?
So we had a couple. I mean, there's really kind of two eras of our relationship with this one. The first was simply we were investors at the beginning, and it was a team we liked. It was a pre-deal one that we liked. We held it through the deal. It was one that got beyond where we wanted to hold on to it. We don't we like to kind of exit fairly quietly. We want to keep good relations with the sponsors, especially the repeat sponsors. But what became very interesting to us is there was a zany mismatch between the warrant and the equity. So this was a very exploitable. Now, what we will tend to do is we are not trying to just arithmetically hedge out any parts of this, but as we exit, typically what it would look like would be buy rating the equity side, hanging on to the warrants. And even at some points when it's dramatic enough, we might sell equity and then reinvest that right back in the warrants in order to flip back into the equity at a better price. But it made almost no sense. There really was no ambiguity on the terms. And sometimes you're getting in an argument with people about the terms when you were discussing the terms pre-IPO, pre-S1. And so you're quite familiar with how the terms work. But, it's a very funny phenomenon. Robinhood doesn't let you trade warrants. You can only trade equity on Robinhood. So some of the ones that get the most retail enthusiasm have it expressed through equity, not warrants. And the warrants have a, you can't instantly convert the warrants to equity. You have to wait a little bit. The fact that there's a little bit of a wait shows how impatient this market is.
Yeah, sometimes like 6 months, right?
Yeah. And but they've actually accelerated that with QuantumScape. That's largely corrected at this point. But I mean, it was a, you could buy the warrants at a massive discount. I mean, I don't like doing anything kind of right at the decimal point. Once, you say this is at a, 30-bit discount, whatever, the market doesn't have to be that perfect. But if it's like a 60% discount and it's, that gets to the point where you can actually just buy the cheap half. And I've had a number of times this year that I've gotten the least friendly response I think I've ever gotten on articles is when I think, oh, I can't capture the arbitrage spread, or I don't want to be short any part of these when it's a team I'm kind of supportive of. And if there's a hard or expensive borrow, but I can always, if there's a big spread, I always think I'm much more attracted to correcting pricing anomalies than necessarily needing to be the individual that captures all of this. So I just buy the cheap part, and I put out an article that says, sell your Nikola. And then I put out an article that says, sell your QuantumScape. And then I say, there's no reason to own this. Normally I say, think for yourself, do your own work, buyer beware. Don't beware. Don't think for yourself. Don't do your own work. Just sell it. Do market order, 9:30 a.m. Sell every share you have. If you want exposure, you can get the same exposure back by the warrants. Let me just stipulate that you think it's a good investment. You own this thing. I can promise you that owning more of the thing that you own is better than owning less with 100% certainty. Now, you're directionally responsible for it, but you own this. So you have some thesis that it's a good thing to own. Don't you want to own more shares? You can own more shares by owning the warrant and flipping back into the equity. And so I figure that you can actually somewhat correct the difference just by explaining it. And it half works, but it's been revealing to me reading the comments. I mean, I think the short version is don't read the comments, but the longer version is if you want to understand the market and there is a 60% mispricing between two things in the cap structure, and you try to just put it out in the public and explain to the people who own the expensive half, you don't get friendly responses to this effort. But I've done that a couple times this year.
But the warrants, they are sometimes difficult to understand, and they're a little bit dangerous to hold because they can force you to exercise it, but you must do it.
Certainly if you get them for free, that has a charm to you. Always feel, I mean, it's some cost, and it's not necessarily rational, but it certainly helps the process, and it certainly helps to understand the terms. I should say, hard to understand. Sometimes the documents aren't even completely consistent. I've seen some drafting errors in SPACs where the warrants have mutually inconsistent terms in different rounds of SEC filings. And boy, that's a situation you don't want to be in. They can be somewhat confusing. But
I guess it couldn't be exploited, or you would have bought a lot of it.
It could. But also, I should say, it makes me very comfortable. Underpaying makes me comfortable, and the second thing that makes me comfortable is constant communication with the people on the other side of these. Because as a research technique, as an elicitation technique, I always think about what any kind of management in an investment I make should do, and not in an activist way or even a bossy way. I just say, hey, I've done the work about your job. Here's all my thoughts. And we get back a lot more feedback than if I had just said, hey, what's going on? And so one of the things I think a lot about is how should you approach the warrants? Does it make sense to tender for the warrants? When should you do that? What are of the things that of the tools in your toolkit, which are the ones that are most rational and optimal? I mean, even sometimes when it's not in my very narrow, obvious interest, sometimes it could be contrary to the appearance of that to go back and say, here's how you should treat this as a research solicitation technique that gives me a boatload of information and helps me hone my judgment on what's likely to happen. So I would say that I've never been surprised on how a warrant has been treated, in part because I understand the terms, in part because I'm constantly communicating with the people who can make the decisions. And we're not trying to be overly tricky. You know, I think there's only been 1 or 2 times where the equities actually raced way ahead of the warrant, where we've wanted to be on the equity side and gotten out of our warrant position. It's much more common the other way. And then a bunch of times it's about right. It's a wash. We kind of hang on to both sides of it. But the difference between the two can be really interesting.
Yeah, and there's like often they have this term that they if the SPAC firm trades above $18 for a number of days, they can force you to exercise it, but now there are a lot that can do that at 10 or something.
Yeah, I mean, my job, I used to, and I stopped saying this anymore because it just doesn't make any sense in this environment. I used to think like, oh, I can provide liquidity where there's liquidity constraints. Now there's no liquidity constraints anywhere. So what the heck, you know, I tell my wife every day now I have to be very nice because nobody needs my capital. And the bad news for me is that there's no reason for them to say yes. But the good news is there's no reason for them to say no. So I have to remind myself every day to not sound like a jerk, because like if you're 10 times oversubscribed, you can indulge every subjective preference you have when you have more of something than you need. And so I think, oh, I don't want to be awful here, but we provide capital.
So maybe I could say those warrants are less attractive in general, and it's a function of the current market.
Yeah, and so, but they can dictate terms, so they can just make it crappy for me, and I'll say yes, please, sir. Can I have another? Literally, that's about all I have to say right now. But then, so they can push me hard now.
But then you actually like those kind of deals because
I personally worry about it less because I want them to have the flexibility, because I have my share of the trust and I have my share of whatever deal they have, and I want them to be able to get a great deal. And one of the things I find that almost the definition of adulthood is there's no rational catharsis. Like whenever you think that victory would feel like sitting on a throne, you know, on top of your enemy's skulls, you always have to defer, because anybody you want to do business with is somebody who has great options. So you're constantly deferring to the sponsors, and then you find an entrepreneur and you want to buy their company, so you're deferring to because if ever you're in a situation where you could have a moment's glory, you throw it away to find a higher quality person to interact with, and then they have options, and then you have to be nice to them too. So in this case, you know, I don't mind them having really attractive securities, even if it's nominally less rich for me, because then that's what they have to go find the very best entrepreneur who can say no to almost anything, could do a direct listing, could do a traditional IPO, could stay private, it's already rich, so he could tell the whole world to go to hell and just go to some private island. We need to attract that person, so they have the warrants that are better for them, so be it. Also, I just don't think they're surprising people that much on how they in practice treat them. You know, they typically want the cash from the warrant holders. We just haven't been surprised that much. It can be an overhang, you know, when there's too many warrants sloshing around. There haven't really been any warrant disaster scenarios where people have gotten much less. And there's a lot of misunderstanding, I think, of people who invest in these, that when they have things where you can be forced, you typically have a timeline where you can sell into the public market, where you can, where the chronology is far more benign than a lot of the kind of fever swamp conspiracy theories and what's going to happen to warrant holders.
Sure.
I own.
No, but you have to pay a little bit of attention, because I mean, a lot of like regular people are in the markets, and in 6 months they're back at their jobs.
Yeah.
And if you forget about your warrants, it can kind of end up sucking for you. So
yeah. I mean, the two things that I have is stern warnings to anybody who's newly looking at this. Seem like weird stern warnings now because everything's working. So you can also just do no work. I mean, every hedge I've done in this area has been a mistake or unhelpful. And so every stern warning, it sounds kind of crazy, but you have to be able to manage your warrant. And you have to manage redemption dates. Like you wouldn't want to have the redemption date come and go in an investment that was based on your trust value being your security, and that disappears one day and your downside goes from 10 down to 0. Of course, stern warning sounds silly now. A lot of these stocks are at 11 on their way to 50 after the de-SPACing. So it doesn't seem like there's anything to worry about, but that is something you wouldn't want to have happen by accident.
Yeah. Yes, some like even traded like $60. Churchill Capital is now. I think you're in that one.
Yeah. It's these deals that are struck at $10. I always have a heightened level of skepticism about market prices that are wildly different almost immediately from the negotiated price. So you have people with inside information, with experts, with incentives, and they reach a deal at a given price. And then the public markets say, no, you're completely wrong. I mean, not 10 or 20% off, but you're an order of magnitude off almost immediately, and nothing's happened. So that's a very recent phenomenon. I think that's going to be very transitory, and it's a mixed bag from where I sit because the pops, I guess, are nice in terms of how you mark your book, but the flip side is it draws competitors like flies, and so you just have to battle for allocations that much more. So in terms of the dollars you're making, the whole thing's a lot more of a chore. The whole thing feels unserious, and you just get huge funds asking for huge allocations. It used to be when I really wanted 10% of an offering, a fairly big ask. And one of my sales traders I was talking with today said, yeah, 7 people in a row just asked for 10% of an offering he was working on. He's just him personally, one of many sales traders at one of a couple of underwriters. So there's, and of course,
so you told them I'll take the whole thing.
Yeah. Well, there's problems after 10% that make it more complicated. But yeah, no, so I say, in that case, yeah, I want 200% of it. Yeah, no, so of course it's silly because then there's this kind of race to exaggerate how much you want to get back into what you get. But I don't bluff. I kind of say what I actually want, and that just gets crowded out in the cacophony right now. So it's a weird moment.
And I'm so curious because like the Churchill Capital is one where there's a rumor and the stock said, it seems like a pretty solid rumor, and the stock said 60 or something. Does that complicate like whether that deal goes through or under what terms or?
I think so. I think it would be better for me to make this next point generically, as opposed to about that one in particular.
We can talk about SPACs that have huge bulk.
So here's how I'd answer that. There are times where it makes sense for a deal advisor to market test a potential combination, and it might make sense for that to be something you would put out to a news source to get a market reaction, so to allow some price discovery in the process. And the market might hate it, the market might be fine with it, or in 2020 and 2021, it might go crazy. The going crazy might tell them that they're on the right track to do the deal, but of course, everybody's paying attention, including all the other SPACs, including say, hey, this is the market reaction. And so I think that you can then have the perverse consequence of then attracting a competitor. So there's times to do things quietly. There's times to do things with either formal contractual exclusivity or just trying to move at a cadence where you actually go from the beginning to middle to end. There's the time for market checks, but I think that can have perverse consequences, can bring in competitors, and we're starting to see on the private side kind of SPAC offs with multiple bidders. We haven't yet seen anything break out into the kind of public bidding war, but that's a real risk you could take.
Right. And let's see. So do you think like something like that, because it also complicates like pipes coming in, and could this even like end up like going down after the deal's actually announced? Because it can kind of influence the terms that the entrepreneurs will ask if they see that the public will have a huge demand for their company.
Yeah, absolutely. Now, on one hand, they can be more demanding. On the other hand, the ones that can be the most demanding are the ones that are in fashion with the thematic investor world that appears to me, at least, to be the least price sensitive, the least interested in price, the most interested in the theme. And so if something was interesting to ARK and Cathie would she like it less at a higher price? She'd probably like it more at a higher price. I mean, I think that the popular investments right now are kind of Veblen goods and get more popular at a higher price. So who knows? I mean, so long-term, 100%, short-term, who knows?
Right. Okay. And so maybe those popular themes are like electric vehicles, batteries. I think
ESG.
Blockchain has probably made a comeback.
Yep.
ESG, I don't think marijuana might be making a comeback. I think it was out of favor for a while.
SaaS seems like it should be perfectly teed up for SPACs. That has been a smaller part of it than I would have thought. And then space is a hot SPAC topic these days.
Yeah, I'm still struggling with that because I think it's so limited, but there are more and more companies, and and like flight. I've seen some flying. Yeah, that's maybe under the space umbrella, right?
You would have done better if you had invested with my 6-year-old at stuff he thinks is cool than you would have with me trying to actually apply any kind of valuation rigor to this whole topic. If you just said stuff my 6-year-old boy thinks is cool, space, rockets, fast cars, that kind of thing, that's seems to be closer to the temperament of the market today. But those
maybe for a few years, I think that's
I mean, I think it's people stuck at home with 0 interest rates. I think that's what comes to the surface. But those are the ones that are really seem to be getting the enthusiasm from retail investors.
But I did infer from my earlier question around the Sam Zell as a team SPAC that you're not above investing in those if you're getting early enough. And so are you trying to predict like which ones will actually get a space deal or a fair deal?
So we certainly reserve our biggest positions, at the beginning, as far as we can, for people who we have the most sincere interest in their actual taste in deals. So on the corporate side, Liberty is one of our favorite ones. It was a big position of ours in the IPO. We haven't sold a share and don't intend to. We fully expect to be involved in whatever deal they find. Greg Maffei is the best corporate deal maker in history. If he can find something that's good as buying Sirius for a few pennies in 2009, having it go up 4,600% since then, we'd be happy. but so for the most part, we're, finding people who are most aligned with our thinking, but they have a lot of flexibility. And so even times where I think we are finding a team that's going to do something that's kind of more the style of deal I would imagine for the very long term I want, a lot of them have nudged into really hot areas, and then the stock's done incredibly well. And so that's more of a short-term bonanza than a long-term high comfort. But there have been there was one other deal that was actually another John Malone lieutenant that I kind of expected would have been more of a Liberty-esque deal. And it was just what this market wants now deal that then went into outer space. And it's been one of the most successful de-SPACs equities ever. So it seems as if,
which one was that, if I can ask? Or
sure, that was Trine, TRME,
desktop metal,
and that was And so of the people that we were very happy to be invested in. That was a great team, Leo Hendry, and nothing against what he found, but he found something that was
then maybe the John Malone, I think those are deal makers, and maybe very contemporary deal makers, maybe flexible deal makers. But maybe I asked you about Sam Zell, because the Sam Zell and the Oak Tree teams, I have a great confidence that these are going to buy something that's going to be an okay value, but they could sit on the money for until for a year easy or longer. And
and it's a real tension. It's probably the people who will be most principled against the current fashion, and so you kind of have to. I don't think you get something that's A+ day one and A+ over the next 5 years. I mean, I think that one of the strangenesses in this market is that the IPO is so constrained on any projections in ways that I find are wholly consistent with what I think is knowable. I mean, but in a kind of strict regulatory sense, you cannot opine on things that I would say just aren't knowable. SPACs, boy, can you ever? I mean, you can talk about your earnings and cash flow in out years. This is somebody who has no earnings or cash flow can talk right at the decimal point, highly specific projections. How much are you going to earn in 2026, and how much is that going to grow in 2027? And then they start bragging against each other, say, "Oh, I hear you're only going to grow 30% this year. 5 years from now, well, I'm going to grow 35." It's all made up. I mean, it couldn't possibly be knowable. And
that's especially convenient if you are in a theme like space where there's no benchmark.
No. And then so it's all the benchmark is can your conscience be more flexible than your competitors' consciences about numbers that you say that are based on nothing? And then the other one, and this is just in a world where it's only optimism, is TAM, is the idea. There's this total addressable market out there, and I just have to reach for it. It'll take me 5 or 10 years, pay me now for its value. I will go get it and I'll have this percentage of it. But the whole conversation seems to sidestep the topic of competitors, that other people can see what I can see and they might take all of it or a lot of it. And it's not clear what, if anything's left over for little old me. And so there's just not the normal give and take of optimism and pessimism. And so we're at a moment that I think it's very hard to find something that fits into that in a pure value investing or distressed, or go after something that's really out of favor and not valued well. I think it's so much more like venture investing than public market value investing. Find something that's kind of grimy, kind of, I love the corporate ones. Andrew Walker, who I work with, noted, and he's 100% responsible for this observation, but it was a great observation, that Greg Maffei actually retweeted, which I thought was cool, that Formula One completely recouped the money that was risked in Liberty Acquisition Corp on their day one securities, in terms of how much they made in day one in their securities, that was put into Formula One. I mean, so it's a perpetual motion machine to put the economics in a public company when the market gives you a 20 or 30% premium for cash and smart guys. Liberty has cash and smart guys. IAC should do IAC SPAC. They're mostly cash and smart guys. Danaher's cash and smart guys. Berkshire should do $100 billion Berkshire SPAC. I rather suspect they won't do it culturally, but there's no reason not to. Anybody who's given a discount on their cash and is good at finding deals should just call it a SPAC.
Yeah, absolutely. So there's really something to these publicly traded companies that are actually sponsors.
Yeah, no, we love the bank shots, SPAC public companies, and have found quite a few that are better than the SPACs that they have exposures in. Andrew's responsible for more of the specifics than I am on this category, but it's a great category to look for. And the public market seemed to really consistently, just a number of times, missed the opportunities there.
Yeah. And so would you ever buy like a Liberty sponsored SPAC for like $12 in the open market if you were just an individual investor? Maybe, or should I rephrase that?
Say it again.
Let's say if you were like an individual investor, would you pay like $12 for a share in Liberty Media?
So here's my price sensitivity, and it's hard right now because things have run up so much on the equities and the warrants in the secondary market, and it's just not something we're kind of day-to-day engaged in. But yeah. I would say the average pop this year has been about 7%. So my first, for how to replicate this as an individual investor, I would say.
You mean on day one of an IPO?
Day one, yeah, day one. So if it starts at 10. If there's something you can get in for under 1070, that's far better. If there's something that you can get in around 1070, you can say, well, that's the average pop. Can you find a much better than average team? That's good. And I would just say I'm dollar for dollar increasingly skeptical as you get beyond 10. You're just paying for, instead of getting the upside in, more and more of the money.
That's cool. That's you give a great benchmark for where you're how you're looking at those things.
And it's fine to have a shopping list. Like, I think that the thing to do is know which teams you love. If you go back 12 months to February 19th, 2021, there were a lot of okay opportunities that if you knew what they were, 3 or 4 weeks later, they were going to become fantastic opportunities. But it was kind of nice, it would have taken too long to do the work in the middle of March on what ones to hoover up. So now might be the time to just have a good big shopping list, know which ones are great deals, and then hoover them up next March 2020.
Yeah. And let's see. There's like one thing, I think you've explained, like the warrant share arbitrage trade that you like a lot. But we kind of left, Chris, do you still have a few minutes? Because I've kept you a long time, but it's so fascinating.
No, a couple minutes would be fine. Were you going to bring up the buy rating and the options?
Yeah, exactly. And maybe I'll do one more question and we'll wrap it up so you can go along with your day.
The options market has kind of gone bananas. And what the prices represent are almost incoherent, especially relative to the trust values. So deals announced, you're able to, after a deal is announced, use options to create stocks very close to trust value, sometimes beneath the trust value, over periods of time that it's unlikely that even close the deal, right? So that you're talking about near term just mostly focusing on near term at the market calls that net of the premium, you're just, and of course you give up the upside. So one thing is, we're not that worried about the opportunity cost because of that phenomenon I told you about, that it's almost inverse between the things I actually like and the things the markets go bananas over. We're not worried about getting the very, very top dollar on some of these where you can buy rate them. You're creating the stock at prices that are vanishingly close to trust value on deals that are already deals that the market's supporting that are likely to get done before redemption date. I mean, the game of it is doing it before you even lose that redemption value. So that's been, I mean, that's kind of a side focus of ours. That's not central to what we do. But in terms of just looking at the mispricing, it feels fairly durable that in this environment, people like the warrants less than the equity less than the calls, and both of those are things that you can kind of replicably take the other side of profitably. And then that also allows you to kind of really de-risk the position, at least relative to the original invested capital. I mean, just to give you an example, I mean, because it's so beyond what I would have expected to see. You know, you're talking about something that's raced so crazy with, you know, double-digit premium monthly. You can collect a month or two of that, and your downside, instead of becoming getting your capital back, is, you know, sometimes a 40 or 50% return on your capital, just waiting a month of premium, and often expires worthless because you don't even necessarily get called away, and you're then creating it net of the premium. You're back down to trust value, sometimes beneath trust value. So it doesn't even make sense. I never would have predicted this opportunity to arise, but it just has. And you know, if you kind of delve into some of the more mass market forums on this, there are people that just, they know what they're doing, they want to do that thing, and they cannot be talked out of it. So it's a real phenomenon that exists, and it can be exploited.
Yeah, I think there are opportunities in this market. I've never seen it in my investing life. It's the greatest thing I've ever seen. So yeah, I think.
And at least for now, I should say, I need to be I need to be super humble about it. The people that I feel I'm exploiting are making a lot more money than I am, right? So I could say, oh, I have this little part of the trade. I think it's very low risk. I think it's very rational. But now I'm writing options, and the people who bought them from me have, at least in the last few months, I mean, they're the smart guys for now.
Yeah, but if I'm guessing you're completely fine with that.
Yeah, I would say I'm completely fine. I think days can go by and weeks can go by, but as months start to go by, at some point, it would be my aesthetic preference to have all the people making more money than me to be smarter, more detailed value investors who spend more time than I do on SEC filings, and were more numerate and more careful and more sober. And I would like to be in line behind them, but that's just an aesthetic preference. And the last few months have been one where I would say I'm actually feeling less parochial and less tied to a need to think of everything in kind of tribal value investing terms, and trying to just be open to the idea that there are some things that I think I can count, and that's what I'm going to do. And I'm not going to move away from that. But as you move away from that, there's other things you can do with investing that's not necessarily bad. It's just, I'm going to let other people make their money there. But boy, are they making a lot of money there right now.
Yeah. And there's a lot of super interesting things happening. Chris, with that, I want to thank you for talking to me for so long, and it's been super interesting. If people want to read your stuff or learn more about you or a firm, where should they go?
I write on Seeking Alpha, especially because of the level of interest in SPACs recently. I've really moved all of my substantive work to Sifting the World, and Sifting the World is my kind of subscription-based platform within Seeking Alpha. So if you go to Seeking Alpha and look up my name, you can find me. But we have members, and their members are people interested in the ideas that we invest in. And it's kind of a good community of people who share ideas, but mostly focused on value investing, special situations, event-driven arbitrage, and more recently, SPACs. It'll seem quite the focus. I think it's the focus for now, and it'll always be part of it. But
it's one of the largest one of the larger communities on Seeking Alpha, I think, and I think you've got a very engaged chat rooms and
So come check us out if you're interested.
Okay, great. And do you have a website or a Twitter or something? Or,
So our website is extremely bare bones because of compliance reasons. We've been dissuaded from a great website. I'm on Twitter, and I think my Twitter handle is basically my name, so I think I'm pretty easy to find on Twitter. But mostly, I think Seeking Alpha is most of my real investment stuff. So check that out if that's of interest. And thank you so much for having me on today. I really enjoyed getting a chance to talk with you.
Yeah, no, thank you very much. And I want to thank all the listeners for tuning in for almost 2 hours. And thanks for listening. Please like, subscribe, share, and see you all next time.